I want you to just imagine trying to sell a massive, really high-ticket item right now.
Like the worst possible time.
Exactly.
Yeah.
I mean, you're operating in this economy where, you know, everyone is feeling the pinch. People are just sweating over interest rates, and consumer confidence feels incredibly fragile right now.
Yeah, people are holding on to their cash.
Right. So common sense tells you that the businesses selling the biggest, most expensive things out there, like homes, should be slamming on the brakes. I mean, you'd think the market would be completely frozen.
Oh, absolutely. It totally defies our standard economic intuition. I mean, when family budgets get tight, buying a, $500,000 house is usually the very first thing that gets postponed indefinitely.
Which is exactly why our deep dive today is so completely counterintuitive.
Yeah.
We got our hands on the fiscal Q2 2026 earnings report from D.R. Horton.
America's builder.
Yep, America's builder. And we're basically going to use this document as a decoder ring. We really want to understand what is actually happening in the U.S. housing market beneath all those surface narratives you see on the news.
And really look at the brutal mechanics of how a corporate giant maneuvers through a really messy economic environment.
Yeah, it's messy.
It's a phenomenal source document, honestly. This earnings release covers the 3 months ending March 31st, 2026.
Yeah.
And the reason D.R. Horton is the perfect lens for this is just their sheer scale.
Right. They aren't just building like a dozen homes a year.
No, not at all. They aren't building luxury bespoke mansions for the 1% in, a single zip code. They operate across 36 different states.
Wow.
Yeah, with price points ranging from entry-level $200,000 homes all the way up to over $1 million. So they are arguably the ultimate barometer for American real estate because their footprint is just so wide.
Right. So I was tearing through the headline numbers, and the very first thing that jumped out is this massive contradiction.
The top line numbers, yeah.
Yeah, like if you just skim the top lines, you see exactly what you'd expect in a tough economy. Their net income for the quarter dropped 20% down to $647.9 million.
Which is a big drop.
It is. And their home building revenue decreased 2% to $7.1 billion. So, a casual observer sees that and thinks, yep, the housing market is struggling, they're making less money, story over.
Right. It perfectly feeds that pessimistic narrative we keep hearing. That top-line revenue drop is a very real reflection of market hesitation.
But then you scroll down the page, and the story literally flips upside down.
This is the crazy part.
It's wild. Their net sales order, so the new contracts people are signing to actually buy a house increased by 11%.
Which is huge.
They took orders for nearly 25,000 homes in a single 3-month window. That's $9.2 billion in future order value surging through the door while current revenue is dipping.
Yeah, the mechanics of the home building industry create this incredible juxtaposition in the data. Like, you are looking at the lag effect playing out in real time here.
Oh, so.
Well, closing a home, finishing the build, navigating the local inspections, that all takes months. So that 2% decrease in current home building revenue, that is essentially a snapshot of past paralysis.
Oh, I see.
Yeah, it reflects the homes that were being negotiated half a year ago when buyers were perhaps, too terrified of the macroeconomic weather to pull the trigger.
Right. It's like looking at the books for a highly rated restaurant.
Okay, I like that.
You see, the cash register took in slightly less money tonight than it did on this exact night a year ago. That's your revenue drop.
Right.
But then the host opens their reservation book, and you see they are suddenly booked solid for the next 6 weeks. The cash register is the echo of yesterday, but the reservation book is screaming that demand is back.
That's a great analogy. That 11% spike in new orders is massive future momentum. Buyers are basically deciding they can't put their lives on hold forever and are finally coming off the sidelines.
Even with interest rates where they are.
Exactly. But think about the operational chaos of that dynamic for a second. Scaling up your labor, securing lumber, and pouring concrete for 25,000 new orders while your current cash flow is actually shrinking, that requires a really ruthless level of operational discipline.
Which brings up the biggest puzzle in this entire document for me. Like, how are they getting 25,000 people to sign on the dotted line right now?
Yeah, that's the real question.
Because I was looking at a quote from their executive chairman, David Auld, and he explicitly says, affordability constraints and cautious consumer sentiment continue to impact new home demand.
Right. He's just putting it right out there.
He is openly admitting the customer is stressed. So if the customer is stressed, how on earth are orders up 11%? Are they just, panicking and slashing prices?
Well, that's the instinct, right, to assume they are just racing to the bottom.
That was my first thought. Like, if nobody is buying, you just take an axe to the sticker price. But that strategy is a total death spiral for a builder.
Oh, absolutely.
Because if you drop the price of a new build by, say, 50 grand, you completely destroy your profit margins. And worse, you tank the comparable home values for the entire neighborhood you are still trying to sell out.
You alienate everyone who already bought a home from you.
Exactly.
And if you look at the financial tables, they definitely aren't doing that. Despite the really challenging market, D.R. Horton maintained a highly respectable consolidated pre-tax profit margin of 11.5% for the quarter.
Wait, 11.5%. That's barely a scratch.
Exactly. They even got a tiny 40 basis point boost from, like, lower warranty costs and some favorable litigation outcome, and they executed so well that they reduced their inventory of unsold completed homes by 35% compared to a year ago.
Wow, 35%.
Yeah. They are moving product incredibly efficiently without destroying their profitability.
Okay, so they aren't dropping the base price, but they are clearly getting buyers over the finish line somehow. The report mentions elevated sales incentives.
Yes, the magic words.
Right. When I first read that, I just assumed it meant throwing in a free upgraded kitchen or, maybe paying for closing costs. But looking deeper into the mechanics of this, these incentives are highly targeted financial weapons.
That's a perfect way to put it.
They are directly attacking the interest rate.
That is the core of their entire strategy right now, because the pain point for the American home buyer isn't always the top-line price of the house. It's the sheer panic of looking at an 8% mortgage rate and calculating that monthly payment.
Oh, totally. If you are trying to buy a house right now, you know this math intimately. Let's say a builder knocks $20,000 off the sticker price of a home.
Which sounds great on paper.
It feels like a nice discount. But spread over a 30-year mortgage, it might only save you, what, $100 a month?
Barely moves the needle on your daily budget.
Exactly. But if the builder takes that same $20,000 and uses it to buy down your mortgage rate, like paying a lump sum to the lender up front to drop your interest rate from 8% down to 5.5%, suddenly your monthly payment drops by $500, $600.
Which fundamentally changes the math of your life.
It's exactly.
You've basically just reverse engineered why they are moving 25,000 units. They are proactively engineering a solution to the exact affordability constraint their chairman mentioned.
Which is brilliant.
It is. I mean, it costs them capital up front, which is why those incentives are elevated in the report, but it protects the baseline value of the home and, most importantly, secures the sale.
Wait a minute, hang on. I'm looking at the breakdown of their business segments here.
Okay, yeah.
They have home building, sure, but they also list rental, 4-star, and financial services.
Ah, right.
If they are spending thousands of dollars per home to buy down a buyer's mortgage rate, and they literally own the financial services company that is writing the mortgage, they are essentially paying themselves.
Welcome to the closed-loop ecosystem of D.R. Horton.
That is crazy.
This is where the business model goes from being just a physical construction company to a highly optimized financial machine.
That is absolutely brilliant. I mean, I was wondering why the margins on their financial services segment were so absurdly high.
Sure.
The report shows that in this quarter, financial services generated $192.8 million in revenue.
Right.
And the pre-tax income on that was $51.7 million. That is a pre-tax profit margin of 26.8%.
Now compare that to the physical act of building the house. The pre-tax margin on the home building side was just 10.7%.
Wow. So their mortgage and title arm is 2.5 times more profitable on a percentage basis than actually swinging the hammers and pouring the foundations.
Well, think about it. Building a house is incredibly capital and labor intensive. You are dealing with real-world supply chains, weather delays, physical materials.
Concrete doesn't care about your schedule.
Exactly. But writing a mortgage or providing title insurance, that is essentially a transaction of data, risk assessment, and capital. The overhead is a fraction of construction. So every time D.R. Horton sells a home and captures the mortgage and title business alongside it, they drastically boost the overall profitability of that single customer. It acts as a massive financial shock absorber.
And that ecosystem approach extends to their rental segment too, which feels a little ironic. You have America's builder functioning as America's landlord on the side.
It's true.
During the quarter, their rental operations generated $211.8 million in revenue. But they aren't acting like a traditional landlord collecting monthly checks from individual families.
No, not at all.
The data shows they sold 566 single-family rental homes and 216 multifamily units. So they are building entire rental neighborhoods and then just selling them off in massive chunks.
often to institutional investors or pension funds or large property management companies. And the mechanics behind this are a brilliant release valve for their operations.
How so?
Well, let's say retail consumer demand completely freezes up because interest rates spike unexpectedly. If D.R. Horton only built homes for individual families, their crews would just sit idle, and their raw material contracts would bleed them dry.
Oh, that makes sense.
But by having a robust build-to-rent pipeline, they can keep their crews moving, keep the concrete flowing, and generate hundreds of millions in revenue from institutional buyers who operate on entirely different financial models than, a family trying to get a standard mortgage.
Right. Even if the profit margin on the rental side was lower this quarter, the report lists it at 5.8%, keeps the engine running.
Exactly.
It means they don't have to fire their best framing crews just because retail buyers are having a slow month.
It guarantees operational continuity.
But okay, to build 80,000 plus homes a year, run this rental pipeline, and feed this massive financial ecosystem, you need dirt.
You definitely need dirt.
You cannot build a house without controlling the land underneath it.
Yeah.
And that brings up maybe the wildest statistic in this entire earnings release.
The lot position.
Yes. I dove into their land and lot position table. Across the entire company, D.R. Horton has 575,300 lots.
It is an unfathomable amount of American real estate.
It really is. But here's the catch. They only actually own 23% of those lots.
Right. 134,100 lots owned outright.
The remaining 77%, which is over 441,000 lots, are merely controlled through purchase contracts.
Yeah.
And I'm looking at this thinking, if I am the biggest player in the game, my instinct is to play Monopoly.
Sure, buy everything.
Yeah. I want to buy the orange properties, build hotels on them, and own the board outright. Why in the world would a company this cash-rich choose to only own a quarter of the land they plan to build on?
The monopoly analogy is really fun, but it actually highlights a fatal flaw in how we think about corporate finance.
Amy.
Well, in a board game, holding property is an absolute good. It always pays out. In the real world, especially in an environment with high interest rates and totally unpredictable demand, holding raw land is a toxic liability.
Wait, how is it toxic? Land doesn't depreciate like a car. It just sits there.
It sits there, yeah, but while it sits, it silently drains your balance sheet. You are paying property taxes to the county every single year. You are spending money navigating local zoning boards.
Right.
And most critically, if you borrowed money to purchase those 500,000 lots, you are paying heavy interest on that debt every single month. If the housing market cools off and it takes you 10 years to build on that land instead of 5, that land becomes dead capital. It generates zero revenue while actively bleeding your cash reserves.
Wow, okay. I see. So if the market turns, the guy holding the most dirt is the one who goes bankrupt trying to pay the taxes on it.
Exactly.
So this controlled strategy, how exactly does that work mechanically? Are they just like calling dibs on the land?
Basically. In corporate finance, it's called an asset-light strategy, and it relies heavily on option contracts. So D.R. Horton goes to a land developer and pays a relatively small, non-refundable deposit.
Okay.
That fee gives them the right, but crucially, not the obligation to buy a specific lot at a predetermined price at a specific date in the future.
So if the housing market completely crashes tomorrow, D.R. Horton can just walk away.
Well, right away.
They lose the small deposit, but they aren't on the hook for millions of dollars of raw land they suddenly don't need.
That is the beauty of the option contract. It transfers the macroeconomic risk from the builder's balance sheet back to the land developer.
That's incredibly smart.
And to mitigate the risk of those land developers going bankrupt and failing to deliver the finished lots, D.R. Horton uses Forestar, their own majority-owned subsidiary, to develop a significant portion of this land. They control the ecosystem without having to hold the heaviest assets directly on the parent company's books.
That actually answers a huge question I had about their balance sheet, because the report states their debt-to-total capital ratio is incredibly low, at just 21.7%.
Which is fantastic.
Right. For every dollar of capital in the business, only about 22 cents is debt. The rest is equity. In a notoriously boom-and-bust industry like construction, having a fortress balance sheet like that seems almost impossible.
It is entirely possible because of that 77% controlled lot strategy. By offloading the land risk and refusing to tie up billions of dollars in raw dirt, they keep their overall debt levels super low. And because their debt levels are low, they aren't suffocating under massive interest payments to banks.
Which creates a fascinating domino effect. Because they aren't paying massive interest to a bank, they have the free cash flow to pay for those elevated sales incentives we talked about earlier.
Exactly. It all feeds back into itself.
The asset-light strategy is the direct fuel that allows them to buy down a customer's mortgage rate and boost their net orders by 11%. It is all connected.
The entire system is engineered for resilience.
Which perfectly sets up the final piece of the puzzle here, capital allocation.
The fun part.
Oh, yeah. When you have a massive financial services arm generating 26% margins and you are avoiding heavy debt by using option contracts on land, you inevitably create a mountain of cash.
A huge mountain.
I was looking at what they did with that cash this quarter, and the numbers literally made me do a double take. In a single 3-month period, D.R. Horton returned $1.0 billion to their shareholders.
It is a staggering deployment of capital.
They repurchased 6.8 million shares of their own common stock for over $900 million. They paid out almost $130 million in cash dividends, and they declared another dividend of 75 cents per share for the next quarter.
Right.
So I'm going to play devil's advocate here for a second, because if you are the listener trying to understand market signals, this feels a little reckless.
Okay, I hear you.
We established that the market is tough. We established they are spending heavily on mortgage buydowns just to get buyers in the door. If winter is coming, shouldn't a conservative company be hoarding that $1 billion in a savings account?
It is a very logical question to ask. If you think a storm is hitting, you board up the windows and hoard cash. But from an investment analysis standpoint, you shouldn't view a massive share repurchase as recklessness.
No.
No, you should view it as the ultimate, unfiltered signal of corporate confidence.
But how does blowing $1 billion show confidence?
Because management teams only pull the trigger on a $1 billion buyback if their internal metrics prove their business is an absolute cash-generating machine, completely regardless of the broader economy.
Okay, let's look at the numbers then.
Let's look at the cash flow data. Their updated guidance for the full fiscal year 2026 projects that consolidated cash flow provided by operations will be at least $3.0 billion.
$3 billion in pure operational cash flow.
Exactly.
That is an enormous safety net.
They can easily fund their daily operations, they can cover their land options, and they can easily manage their debt. The report explicitly mentions they only have $600 million of home-building senior notes maturing in the next 12 months.
Oh, wow.
Against $6 billion in total available liquidity, that debt is just a rounding error. They have mountains of cash left over.
So buying back the stock isn't draining the emergency fund. They've already funded the emergency fund, paid the bills, and are basically just trying to figure out what to do with the excess. But let's break down the mechanics of the buyback for a second, because it's a fascinating way to reward investors. By repurchasing those 6 million shares, the report notes they have shrunk their total common shares outstanding by 8% year over year.
They are actively shrinking the pie.
Right, so if a company is a pizza and you just remove 8% of the slices, the remaining slices inherently become bigger. Every single share of D.R. Horton that an investor holds today now represents a mathematically larger claim on the company's total future earnings.
Yep.
When management aggressively shrinks the share count in a cautious market, they are screaming to Wall Street. We believe our stock is fundamentally undervalued, and we are betting $1 billion on ourselves.
And their operational efficiency really backs up that bet. I mean, they are posting a 13.2% return on equity and an 8.9% return on assets over the trailing 12 months. They are generating highly efficient returns on the capital they deploy.
It's impressive.
The $1 billion returned to shareholders proves they can reward their investors while simultaneously navigating a really difficult high-interest rate environment.
So, bringing this all home for you listening. Whether you are analyzing the real estate sector for your own investments, prepping for a corporate strategy meeting, or you just want to understand why housing feels so utterly disconnected from the rest of the economy right now. D.R. Horton's Q2 report is a masterclass.
Truly.
It proves that thriving in a difficult macroeconomic environment isn't about ignoring the reality of the market. It is about brutally disciplined execution.
It requires an incredible understanding of your customer's actual pain points.
Exactly. You don't just, slash the price of the house. You build a closed-loop financial ecosystem that allows you to buy down their mortgage rate through your own lending arm.
Right.
You don't hoard massive tracts of land out of ego. You use option contracts to stay asset light and keep your debt at 21%. You construct a machine that absorbs the shocks of the market rather than fighting them.
It is a remarkable case study in corporate agility. And, as you digest all these mechanics, I'd like to leave you with one final provocative thought to mull over.
Let's hear it.
We have spent this entire deep dive analyzing how D.R. Horton is successfully growing their future orders by 11% right now in the teeth of a tough economy. And they're doing it by leaning heavily on elevated sales incentives, paying out of pocket to artificially lower interest rates so buyers can actually afford the monthly payments.
Right. They are spending their own margins to fix the math for the customer today.
So here's the question. What happens to this massive, highly optimized machine when macroeconomic conditions eventually shift and mortgage rates naturally fall on their own?
Oh, wow.
Right. If they no longer have to spend tens of thousands of dollars per home on mortgage rate buydowns just to get a buyer in the door, if they are this remarkably profitable with 26% margins in financial services and a fortress balance sheet during the tough times,
Yep.
imagine what their margins and cash flow will look like when the economic wind is finally at their back.
Man. They built a ship designed to survive a hurricane, but they might just own the entire ocean when the sky finally clears.
Hmm.
We will leave you to ponder that.